Before we begin, a quick and important disclaimer. The content provided in this video is for educational and entertainment purposes only and does not constitute professional legal, financial, or tax advice. Retirement accounts and divorce proceedings are governed by complex federal and state laws, including ERISA and the Internal Revenue Code. Every individual situation is unique, and the information shared here should not be used as a substitute for consultation with a qualified attorney or a certified financial planner. We strongly warn all viewers to conduct their own due diligence and seek professional counsel before making any decisions regarding their assets. Imagine working for 35 years, diligently contributing to your 401k, passing up vacations and luxury purchases to ensure your future is secure, only to realize that a single signature in a courtroom could instantly divert 50% of those funds to an ex-spouse. In the United States, retirement accounts are often the largest or second largest asset in a household, frequently surpassing the equity in the family home. Yet, most people enter divorce proceedings with a fundamental misunderstanding of how these accounts are actually divided. They assume that because their name is the only one on the account, the money is untouchable. That assumption is not just wrong. It is a financial catastrophe waiting to happen. Today, we are opening the hood on the academic and legal discourse surrounding 401k division in the USA. This is the first part of a 10-part masterclass designed to move beyond the surface-level tropes of divorce court and into the granular, technical realities of asset protection, valuation, and the federal laws that govern your hard-earned savings. By the end of this deep dive, you will understand the precise mechanics of the Qualified Domestic Relations Order, or QDRO, the distinction between separate and marital property in various jurisdictions, and the hidden tax traps that can turn a seemingly fair settlement into a lopsided loss. We are solving the problem of financial illiteracy in the face of litigation, providing you with the historical trends and case studies necessary to navigate one of the most stressful periods of a person's life with clarity rather than chaos. To understand the 401k in a divorce context, we must first look at its legal DNA. A 401k is a defined contribution plan governed by the Employee Retirement Income Security Act of 1974, commonly known as ERISA. Because ERISA is a federal law, it generally preempts state laws. This creates a fascinating and often frustrating tension in divorce court. While state courts handle the dissolution of marriage and the equitable distribution of property, they cannot simply order a plan administrator to cut a check to a non-employee spouse. The plan administrator is bound by federal fiduciary duties to follow the plan's specific terms. This is why a standard divorce decree is usually insufficient to move 401k funds. You need a specific legal bridge known as the QDRO. Without this bridge, you are essentially knocking on a door that federal law has double-bolted. Let's look at the concept of marital versus separate property, as this is the foundational battlefield of any 401k dispute. In the United States, jurisdictions generally fall into two categories: community property states and equitable distribution states. In a community property state like California or Texas, the law typically views all assets acquired during the marriage as owned equally by both partners. If you started your 401k on the day you got married and are now divorcing, the starting point is often a 50-50 split of the entire balance. However, in equitable distribution states, which make up the majority of the U.S., the court looks for a fair distribution, which is not always equal. The court might consider the length of the marriage, the age of both parties, their respective earning capacities, and even who will be the primary caregiver for children. The academic complexity increases when we consider the coverture fraction, or the Majoska's formula. These are mathematical tools used by courts to determine the marital portion of a retirement account when the employee spouse started the job before the marriage began. For example, if a worker contributed to a 401k for 5 years while single, then got married and continued contributing for another 10 years before filing for divorce, only a portion of that account is considered marital property. The separate property, the contributions and the growth on those contributions from the first 5 years, must be carved out. This sounds simple in theory, but in practice it requires forensic accounting. You have to account for market fluctuations, employer matching, and whether the growth on the separate portion is considered active or passive. If the growth happened purely because the S&P 500 went up, it might remain separate. If the growth happened because the spouse actively managed the trades during the marriage, some jurisdictions might argue that the effort expended during the marriage makes that growth a marital asset. Consider the case study of a mid-level executive in Illinois. He entered the marriage with $200,000 in his 401k. Over a 12-year marriage, The account grew to $1.2 million through a combination of new contributions, a generous company match, and aggressive market gains. During the divorce, his legal team argued that the initial $200,000, plus the proportional growth on that specific amount, should be shielded. The opposing counsel, however, argued that because the marital contributions were commingled with the premarital funds in the same account, the entire balance had become transmuted into marital property. This concept of transmutation is a high-stakes risk in financial litigation. If you cannot clearly trace the separate property through documented statements, you risk the court viewing the entire account as one big marital pot. Furthermore, we must address the valuation date problem. Markets are volatile. If a couple files for divorce in January when the 401k is worth $500,000, but the final judgment isn't signed until September when the market has dipped and the account is worth $420,000, who bears that loss? Conversely, if the market rallies to $600,000, does the non-employee spouse get a windfall? Most modern settlements utilize a specific date of valuation, but the lag time in drafting and approving a QDRO can create a limbo period where tens of thousands of dollars hang in the balance. This is why academic discourse in this field emphasizes the percentage versus fixed dollar approach. If the court awards a spouse $100,000, they get exactly that. If the court awards them 50%, they are tethered to the market's performance until the transfer is complete. Then there is the issue of loans. It is common for participants to take loans against their 401k for a home down payment or to consolidate debt. In a divorce, a 401k loan is a liability that sits inside an asset. If there is a $40,000 outstanding loan, the net value of the account is reduced. But who is responsible for paying that loan back? If the participant spouse keeps the account but the loan was used to renovate the marital kitchen, should the non-participant spouse have their share reduced by half the loan value? These are the granular details that viral get-rich-quick financial advice ignores, but they are the details that determine whether you walk away with a functional retirement or a tax-burdened shell. Lastly, in this introductory segment, we must touch upon the psychological and systemic reality of the offset. Often, rather than splitting the 401k through a QDRO, couples will engage in an asset swap. One spouse keeps the house, and the other keeps the 401k. On paper, if both are worth $300,000, it looks like a wash. However, academically and financially, this is often a false equivalency. The house is bought with post-tax dollars and may have a primary residence capital gains exclusion. The 401k is filled with pre-tax dollars, meaning every dollar withdrawn in the future will be taxed as ordinary income. A $300,000 house and a $300,000 401k are not equal. The 401k is effectively worth significantly less once the tax ghost is accounted for. Understanding these nuances is the difference between a settlement that looks good on Tuesday and a retirement that fails on a Sunday 10 years from now. As we move into the subsequent parts of this series, we will break down the specific IRS codes and QDRO drafting techniques that protect you from these exact scenarios. To truly grasp the gravity of 401k division, we must dissect the legal mechanism that makes it possible. The Qualified Domestic Relations Order, or QDRO. In the year 2026, the complexity of these orders has only intensified as retirement plans incorporate more diverse investment vehicles. A QDRO is not a suggestion. It is a highly specific judgment, decree, or order that creates or recognizes the existence of an alternate payee's right to receive all or a portion of the benefits payable with respect to a participant under a retirement plan. Without a properly executed QDRO, the Internal Revenue Service views any transfer of 401k funds as a taxable distribution. If you simply withdraw the money to pay an ex-spouse, you could be hit with a 10% early withdrawal penalty if you are under age 59 and a half, plus federal and state income taxes that could consume nearly half the total amount. Imagine a scenario involving a software engineer named David in Seattle. David has been married to Sarah for 15 years. During their marriage, David's 401k grew to $800,000. As they settle their divorce in 2026, they agree to an equal split of the marital portion. If David simply writes Sarah a check or moves the money to her personal savings account, the IRS treats this as David taking the money for himself. David would owe the taxes and the penalty, leaving him with significantly less than the $400,000 he intended to keep. However, the QDRO allows for a tax-free transfer. The funds move directly from David's 401k into Sarah's own 401k, or a rollover individual retirement account. Sarah then becomes responsible for the taxes only when she eventually withdraws the money in retirement. This legal fiction treats the transfer as if the money never left the tax-advantaged umbrella. The drafting of the QDRO is where many people encounter catastrophic errors. Plan administrators are notoriously pedantic. If the name of the plan is off by a single letter, or if the order fails to specify how investment gains and losses are handled between the date of the decree and the date of transfer, the administrator will reject it. Historical trends show that a rejection can add 6 to 12 months to the process, during which time the participant spouse might continue to make contributions or take loans, further complicating the math. Academic studies on domestic relations law emphasize that the QDRO must address 5 critical elements: the name and last known mailing address of the participant and the alternate payee, the name of each plan to which the order applies, the dollar amount or percentage of the benefit to be paid, the number of payments or the period to which the order applies, and a clear statement that the order does not require the plan to provide any type or form of benefit not otherwise provided by the plan. Let us look at a case study involving the concept of the earnings and losses clause. Suppose a court orders that an alternate payee receive $200,000 from a 401k. Between the time the order is drafted and the time the plan administrator processes it, the stock market experiences a significant downturn. If the QDRO did not specify that the $200,000 should be adjusted for market losses, the participant spouse is forced to bear the entire brunt of the market crash. They must still pay the full $200,000, even if their remaining share has dwindled. Conversely, if the market surges, the alternate payee misses out on the growth that occurred while the paperwork was sitting on a desk. Professional practitioners in 2026 use language that ensures both parties share in the market's volatility proportionally. This level of detail is the difference between an equitable split and an accidental financial penalty. Another layer of this discourse is the anti-alienation provision of ERISA. Section 206, D.1 of ERISA states that benefits provided under the plan may not be assigned or alienated. This was designed to protect workers from creditors and from themselves. The QDRO is one of the very few exceptions to this rule. Because it is a federal exception, the plan administrator acts as a gatekeeper. They have a fiduciary duty to the plan, not to the divorcing couple. If the divorce decree says the ex-spouse gets the money immediately, but the plan rules state that no distributions can be made until the participant reaches age 55, the plan rules win. The alternate payee might have to wait years to see a dime. This is often a shock to spouses who were counting on those funds to buy a new home or pay off debt immediately after the divorce. Consider the historical trend of the separate interest versus shared interest approach. In a separate interest QDRO, the alternate payee's portion is carved out and treated as their own independent account. They can often choose their own investments and decide when to start taking distributions based on their own age. In a shared interest QDRO, the alternate payee only receives a portion of each check as the participant receives it. This is more common in traditional pension plans but is still relevant in some older 401k structures. The choice between these two approaches can have a massive impact on the long-term value of the settlement. For instance, if the alternate payee is much younger than the participant, a separate interest approach might allow the money to grow for an additional decade. Furthermore, we must examine the specific tax implications of the 2026 tax brackets. As the U.S. economy navigates shifting fiscal policies, the timing of a 401k distribution becomes a strategic move. There is a specific nuance under Internal Revenue Code Section 72, T.2c. If an alternate payee receives a distribution from a 401k pursuant to a QDRO, they are exempt from the 10% early withdrawal penalty even if they are under age 59 and a half. They still owe income tax, but the penalty is waived. This is a unique escape hatch that only exists for 401k plans and not for IRAs. If the money is rolled over into an IRA first and then withdrawn, the penalty waiver vanishes. In Part 3, we will see how this specific rule can be used as a liquidity tool, but also how it can be a dangerous trap if not executed with precision. There is also the matter of the segregated account. Once a QDRO is submitted for review, the plan administrator is often required to segregate the disputed funds into a separate, interest-bearing account. This prevents the participant spouse from liquidating the account or taking a loan that would undermine the court's order. However, being in a segregated account often means the money is out of the market. In a bull market, this safety is actually an opportunity cost. Imagine a spouse named Michael who has $500,000 in his 401k. The QDRO process takes 9 months due to administrative backlogs. During those 9 months, the S&P 500 rises by 15%. Because the funds were segregated and sitting in a low-interest cash equivalent, the couple effectively lost $75,000 in potential growth. This academic reality highlights why speed and technical accuracy in drafting are not just clerical concerns. They are direct financial imperatives. We must also dive into the survivor benefits aspect. What happens if the participant's spouse passes away after the divorce is finalized but before the QDRO is officially approved by the plan? In many historical case studies, the alternate payee lost everything because the plan's default beneficiary was a new spouse or the participant's estate. The QDRO must be drafted to include prospective alternate payee protections or designate the ex-spouse as the surviving spouse for the purposes of the plan's death benefits to ensure the interest is protected during the administrative waiting period. But what if the 401k contains more than just stocks and bonds? What if it contains company stock with significant unrealized appreciation? This introduces the concept of net unrealized appreciation, or NUA, which is a sophisticated tax strategy that can be split or assigned in a divorce. If the QDRO is not drafted to account for the NUA treatment, the tax advantages of the company stock could be permanently lost, costing the family hundreds of thousands of dollars in higher tax rates. As we conclude this part of the masterclass, you are starting to see that the 401k is not a stagnant bucket of cash. It is a living, breathing legal entity governed by federal mandates that can either work for you or against you. We have covered the QDRO bridge and the risks of segregation, but we haven't yet touched on the most controversial part of the process: the calculation of the marital coverture, when there are multiple employers, merged plans, and missing statements from the 1990s. In Part 3, we will investigate the forensic accounting techniques used to track down hidden growth, and how to handle 401k plans that have been rolled into multiple different vehicles over a 30-year career. If you think your statements tell the whole story, you are only seeing the surface. Next, we go into the basement. Tracing the lineage of a 401k is often less like accounting and more like archaeology. By the year 2026, the average American worker changes jobs nearly a dozen times throughout their career, leaving a trail of abandoned or rolled over retirement accounts in their wake. When a divorce filing occurs, the court doesn't just look at the current balance. It looks at the source of every cent. This brings us to the basement of financial litigation, the tracing and characterization phase. If you cannot prove where the money came from, the court will almost certainly default to the assumption that it is marital property. Imagine a project manager named Robert in Ohio. Robert is 55 and has been married to his spouse, Elena, for 20 years. Robert has a 401k worth $1.5 million. However, Robert started working 10 years before he met Elena. During those 10 years, he diligently saved. When he got married, he stopped contributing to that specific old 401k but left it to grow. 5 years into the marriage, he rolled that old 401k into his current employer's plan to consolidate his finances. Now, in 2026, Elena's legal team is claiming half of the entire $1.5 million. Robert's challenge is to prove which portion of that million-plus balance is his separate, premarital property and which portion is the marital growth they built together. This is where we utilize the direct tracing method. Robert must find the account statements from 20 years ago, specifically the statement from the day before his wedding. If those records are lost because the old brokerage firm merged or the digital records didn't migrate, Robert is in a high-risk position. In the academic study of forensic accounting, this is known as the commingling trap. Once Robert rolled his separate, premarital funds into a plan where marital contributions were being made, he mixed the separate water with the marital wine. Without a clear paper trail, the court may determine that the separate property has been transmuted into marital property because it can no longer be identified with reasonable certainty. Let us look at a case study involving the time-weighted return versus the simple pro rata split. In many jurisdictions, courts use a coverture fraction to determine the marital share. This is a ratio where the numerator is the number of months the party participated in the plan while married, and the denominator is the total number of months of participation. If Robert participated for 300 months total and was married for 200 of them, the marital portion is 2/3. But this formula is intellectually lazy and often financially inaccurate. It assumes that the 401k grew linearly, which it never does. $1,000 contributed in 1995 has significantly more growth potential than $1,000 contributed in 2025. In a deep dive analysis, a forensic accountant will perform a step-by-step reconstruction. They will isolate the premarital balance and apply the actual market returns of the specific funds Robert was invested in during those years. They will then subtract that calculated amount from the current balance to find the true marital portion. This often reveals that the separate property grew much faster or slower than the marital contributions, potentially saving or costing a party hundreds of thousands of dollars. Historical trends in U.S. family law courts show a shift toward this more precise, data-driven tracing, but only if the party requesting it provides the necessary evidence. Another layer of complexity in the 2026 landscape is the issue of merged plans. In the corporate world, mergers and acquisitions are constant. When Company A buys Company B, the 401k plans are often merged. For a divorcing couple, this creates a massive data gap. Plan administrators may only keep records for 7 to 10 years. If the marriage lasted 25 years, the current plan administrator might have no record of what was in the account 15 years ago. This requires subpoenas to previous record keepers and potentially hiring a digital forensics expert to recover old tax returns or Form 5500 filings, which are public records that provide a high-level view of a company's retirement plan assets. Now, imagine the scenario of a 401k loan that was taken out but never repaid. Suppose Sarah, a marketing executive, took a $50,000 loan from her 401k during the marriage to pay for a family emergency. At the time of divorce, that loan is still outstanding. From a legal standpoint, that $50,000 is gone from the account, but it is still an asset because it is expected to be paid back. If Sarah is the one responsible for the loan, but the court orders the account to be split 50-50, Sarah effectively loses twice. She has a smaller account balance to split, and she is still on the hook to pay back the full loan to the plan. Academic discourse on this topic suggests that 401k loans should be treated as marital debt if the proceeds were used for marital purposes. In 2026, sophisticated legal teams are drafting settlements that specifically address the amortization of these loans. They might offset the loan against other marital assets, such as a savings account or equity in a vehicle, to ensure that the 401k split is based on the gross value of the account, not the loan-reduced net value. If this is ignored, one spouse often ends up subsidizing the other's debt repayment through their reduced share of the retirement fund. We must also discuss the concept of active versus passive appreciation. This is one of the most litigated areas of 401k divorce. Passive appreciation is the growth of an asset due to market forces. Active appreciation is growth due to the efforts of one of the spouses. If Robert's 401k grew because he spent every evening researching stocks and manually trading within his brokerage window inside the 401k, Elena's attorneys could argue that his effort was a marital contribution. In many U.S. states, the time and talent of a spouse during the marriage are considered marital assets. Therefore, even the premarital portion of the 401k might be subject to a claim if it can be proven that Robert's active management significantly boosted its value. This is why many financial advisors recommend that if you have a large premarital 401k, you should keep it in a hands-off target date fund to ensure that all growth is clearly categorized as passive. Step by step, the process of navigating the basement of a 401k involves: first, identifying every retirement account held by both parties, including those from former employers. Second, obtaining the summary plan description for each plan to understand the specific rules for QDROs and withdrawals. Third, securing statements from the date of marriage, or as close to it as possible, to establish a baseline for separate property. Fourth, determining if any loans or withdrawals occurred during the marriage and how those funds were used. Fifth, analyzing the investment history to categorize growth as active or passive. The data shows that couples who spend the money upfront on forensic accounting and clear characterization of assets often save significant amounts in the long run by avoiding prolonged litigation and unfair settlements. However, even with perfect records, there is a hidden variable that most people overlook until it is too late: the cost basis of the investments. If a 401k contains highly appreciated company stock, the tax implications of selling that stock inside the plan versus rolling it out can be massive. But what happens when the 401k isn't the only retirement vehicle? What if there is a parallel pension or a non-qualified deferred compensation plan that interacts with the 401k? Many high-earning individuals in the U.S. have complex wraparound plans that only trigger once the 401k hits its annual contribution limit. These plans are not governed by ERISA and do not use QDROs, yet they are often inextricably linked to the 401k's performance. As we move into Part 4, we are going to look at the dark matter of retirement division. We will explore how to handle non-qualified plans, the impact of Social Security offsets in certain states, and the specific 2026 tax law changes that affect how much of that 401k you actually get to keep after the government takes its share. We've mapped the basement and traced the history, but now we have to deal with the invisible forces that can pull a settlement apart from the inside. Do you know if your 401k is being offset by your spouse's future Social Security benefits? If you don't, you might be leaving six figures on the table. We explain why in the next part. The intersection of Social Security and 401k division is one of the most misunderstood areas of American family law. In 2026, as the first wave of late career professionals faces the reality of shifting retirement ages, this academic discourse has taken on a new urgency. To understand why your 401k might be offset by Social Security, we have to look at the concept of Social Security equivalency. Federal law is very clear. Social Security benefits themselves cannot be divided in a divorce court. Under the Social Security Act, specifically 42 U.S. Code Section 407, these benefits are non-transferable and non-assignable. However, state courts in jurisdictions like Ohio, Pennsylvania, and others have developed a workaround known as the Social Security offset. Imagine a scenario in 2026 involving a couple, Thomas and Linda. Thomas has spent 30 years working for the federal government in a position where he did not pay into Social Security, but instead contributed heavily to a 401k-style thrift savings plan. Linda, meanwhile, worked in the private sector and has a substantial projected Social Security benefit, but a much smaller 401k. If the court simply divides the 401k accounts down the middle, Thomas loses half of his only retirement source, while Linda keeps half of his 401k plus 100% of her future Social Security checks. In this scenario, the court may calculate the present value of Linda's future Social Security benefits and use that number to offset the 401k distribution. If Linda's projected benefits are valued at $300,000, the court might allow Thomas to keep an extra $300,000 of his 401k to reach a state of equitable balance. This is not dividing Social Security. It is using the math of Social Security to redistribute the 401k. This leads us into the high-stakes world of non-qualified deferred compensation plans, often referred to as NQDC or Top Hat plans. In 2026, many high-earning professionals in the United States use these plans to bypass the contribution limits of a standard 401k. While a 401k is governed by ERISA and protected by federal law, an NQDC plan is essentially an unsecured promise from an employer to pay the employee at a future date. This creates a massive risk during a divorce. If a QDRO is the golden key for a 401k, it is a useless piece of metal for an NQDC plan. These plans do not recognize QDROs because they are not qualified plans. Consider a case study of an executive named Marcus at a major tech firm in California. Marcus has $2 million in a 401k and another $3 million in a deferred compensation plan. In a divorce, his spouse, Jennifer, wants half of everything. Dividing the 401k is straightforward via QDRO. However, the deferred compensation plan is technically part of the company's general assets. If the company goes bankrupt in 2027, that $3 million could vanish. If the divorce decree orders Marcus to pay Jennifer half of that deferred money today, Marcus is taking on a massive risk. He would be paying her in real current cash for an asset that might never materialize. Academic Discourse in 2026 suggests using a constructive trust for these assets. Marcus would be ordered to hold Jennifer's portion in a trust and pay her only if and when the company pays him. This aligns the risk between both parties, but it keeps them financially tied together for years, which is often the last thing a divorcing couple wants. The step-by-step reality of handling these complex dark matter assets begins with a deep audit of the Employee Benefits Manual. You must look for change of control provisions. If Marcus's company is bought out during the divorce, his deferred compensation might accelerate and become taxable immediately. If the legal team hasn't prepared for this, the tax bill alone could bankrupt the individual spouse who was ordered to pay out a settlement based on the pre-tax valuation. This brings us to the crucial concept of tax impact discounting. In 2026, with federal tax brackets frequently being a point of legislative debate, $1 in a 401k is fundamentally different from $1 in a Roth 401k or $1 in a brokerage account. Imagine if a couple is splitting $1 million. One spouse takes $500,000 in a standard 401k, and the other takes $500,000 from a Roth 401k. On the surface, it is a 50-50 split. However, the spouse with the Roth 401k has $500,000 of spendable, tax-free money. The spouse with the standard 401k actually has about $350,000 after federal and state income taxes are factored in at the time of withdrawal. In a 2026 masterclass on this topic, we advocate for the use of tax-affected valuations. Forensic accountants will apply a projected tax rate to the pre-tax 401k to determine its real-world value today. Without this adjustment, the spouse receiving the traditional 401k is essentially agreeing to pay the other spouse's future tax bill. Data from historical trends suggest that failing to account for the tax nature of these accounts is one of the top 3 reasons for post-divorce financial litigation. Another invisible force is the 401k's beneficiary designation. Many people assume that a divorce decree automatically revokes their ex-spouse right to their 401k if they die. This is a dangerous misconception. Because 401ks are governed by federal ERISA law, they often override state laws that provide for automatic revocation upon divorce. In the landmark case of Egelhoff versus Egelhoff, the Supreme Court ruled that the plan administrator must pay the person listed on the beneficiary form, regardless of what the state divorce law or the divorce decree says. If Marcus divorces Jennifer but forgets to update his 401k beneficiary form and passes away in 2028, the plan will pay Jennifer the entire balance, and Marcus's new family or heirs may have no legal recourse to recover those funds. Furthermore, we must address the 2026 landscape of the Secure Act 2.0 and its subsequent updates. New rules regarding required minimum distributions and the ability to roll over 401k funds into other vehicles have changed the math on how we value these accounts. For instance, if a 401k is being divided and one spouse is significantly older, the timing of the distribution becomes a major factor in the settlement's liquidity. If the older spouse is already 75, they are in the middle of required distributions, which can complicate a QDRO transfer. The plan might be forced to liquidate certain positions to satisfy the distribution before the transfer can even occur. The complexity reaches its peak when we look at 401k plans that contain private equity or non-publicly traded assets. In 2026, more 401k plans are allowing for alternative investments. These assets do not have a daily ticker symbol. How do you divide 50% of a private equity stake that won't have a liquidity event for another 5 years? The academic solution is often a shared interest order, where the alternate payee is granted a right to a percentage of the proceeds only when the asset is sold. But this requires the plan administrator to be willing to track an alternate payee for years, which many smaller plans are unwilling to do. As we wrap up this 4th segment, the picture is becoming clearer. The 401k is the center of a much larger solar system of assets. It is influenced by the gravity of Social Security, the shadows of non-qualified plans, and the heat of future tax liabilities. If you are only looking at the balance on your last statement, you are flying blind. We have discussed how to identify these invisible forces, but we haven't yet talked about the actual execution of the split, the moment the money moves. In Part 5, we are going to dive into the technical execution of the QDRO transfer, the specific timing traps that can freeze your assets for months, and the little-known immediate cash-out rule that allows a divorcing spouse to access 401k funds without a penalty to pay for their legal fees. If you need liquidity now, you cannot afford to miss the next part. We are going to show you how the law provides a one-time window to unlock your 401k without the usual age restrictions. The one-time window for liquidity that we are discussing centers on Internal Revenue Code Section 72, T, 2, C. In the standard world of 401k management, taking money out before age 59.5 is a cardinal sin that triggers a 10% excise tax penalty on top of your regular income tax. However, the United States Tax Code recognizes that divorce is a period of extraordinary financial transition. When a 401k is divided via a Qualified Domestic Relations Order, or QDRO, the alternate payee, the spouse receiving the funds, has a unique, time-sensitive opportunity. They can elect to take a direct cash distribution of their awarded portion, or a part of it, and the 10% early withdrawal penalty is waived by federal law. Imagine a scenario in 2026 involving a teacher named Amanda in Virginia. Amanda is 42 years old and is divorcing her husband, who has a 401k valued at $600,000. As part of the settlement, Amanda is awarded $300,000. Amanda is facing immediate costs: a security deposit on a new apartment, legal fees that have accumulated over 18 months, and the need to replace a failing vehicle. If Amanda were to withdraw $30,000 from her own IRA, she would lose $3,000 immediately to the IRS penalty. However, because these funds are coming to her via a QDRO from her ex-spouse 401k, she can instruct the plan administrator to pay that $30,000 directly to her as a cash distribution. She will still owe ordinary income tax on that amount, but the 10% penalty is legally bypassed. This is a critical distinction in academic financial planning. This specific waiver applies only to distributions from a qualified plan like a 401k or a 403b under a QDRO. If Amanda were to roll the entire $300,000 into her own rollover IRA first, and then try to take the $30,000 out, the window closes. The IRA does not recognize the QDRO penalty waiver. Once the money touches an IRA, it is governed by IRA rules, which generally do not include the 72T divorce exception. This is a mistake that costs American divorcees millions of dollars in unnecessary penalties every year. In our 2026 analysis, we see that the timing of this election is everything. The decision to take the cash out must typically happen at the moment the QDRO is being processed by the plan administrator. Historical trends show that plan administrators operate with the speed of a glacier. From the moment a judge signs the QDRO, there is a multi-step verification process. First, the order is sent to the plan's legal department or a third-party QDRO coordinator. They review the document to ensure it strictly adheres to the plan's specific requirements. If the order passes, they send a notice of qualification to both parties. Only then does the segregation of assets begin. In 2026, the administrative backlog for major U.S. employers can range from 60 to 90 days just for this review phase. During this time, the money remains in the participant's account, subject to market fluctuations unless the order specifically commanded a move to a stable value fund. Let us look at a case study of the valuation gap. Imagine a participant named Christopher whose 401k is heavily invested in high-growth tech stocks. The divorce decree specifies that his ex-wife, Michelle, is to receive 50% of the account valued as of January 1, 2026. On that date, the account is worth $1 million. However, due to legal delays, the QDRO isn't finalized until June. By June, the tech sector has corrected, and the account is now worth $800,000. If the QDRO was drafted poorly, specifying a fixed dollar amount of $500,000, Christopher is left with only $300,000. He has absorbed the entire $200,000 market loss. Conversely, if the QDRO was drafted as a percentage, Michelle receives $400,000. The academic discourse here focuses on the use of earnings and losses clauses. A sophisticated QDRO will state that the alternate payee receives 50% of the balance as of the valuation date, adjusted for investment gains and losses until the date of actual distribution. This ensures that both parties ride the market wave together, for better or worse. The technical execution also involves the concept of the separate account for the alternate payee. Once the QDRO is qualified, most modern 401k plans will physically move the awarded funds into a new account under the alternate payee's Social Security number, still within the same employer plan. This is a crucial moment for the receiver. Often, the receiver ignores this new account, leaving the money in whatever funds the participant had chosen. If the participant was an aggressive investor and the receiver is conservative, the receiver is now exposed to risk they didn't bargain for. Step by step, the receiver must immediately contact the plan administrator to gain online access to their separate account, review the investment lineup, and rebalance the portfolio to match their own risk tolerance. Furthermore, we must address the tax withholding trap during the cash-out process. When Amanda, our teacher from Virginia, decides to take her $30,000 distribution, the plan administrator is required by federal law to withhold 20% for federal income taxes. So, although Amanda asked for $30,000, she will only receive $24,000 in her bank account. If she actually needed $30,000 to cover her expenses, she needs to gross up her request. However, if her total income for 2026 puts her in the 24% tax bracket, she will still owe an additional 4% at the end of the year. Academic practitioners emphasize that you must view the 401k cash out as a gross number, not a net number. Another layer of depth involves the 401k's cost basis and company stock. If the 401k contains shares of the employer's company, and those shares have appreciated significantly, there is a strategy called net unrealized appreciation, or NUA. In a divorce, the NUA treatment can be transferred to the alternate payee. This allows the receiver to move the company stock into a regular brokerage account, paying ordinary income tax only on the original cost of the stock, while the growth is taxed at the much lower long-term capital gains rate when sold. In 2026, with the gap between ordinary income and capital gains rates remaining significant, failing to identify NUA stock in a 401k division can be a massive missed opportunity for tax efficiency. Imagine if the 401k belongs to a spouse who is already in pay status. This means they are already retired and receiving monthly distributions. In this case, the QDRO doesn't just split a lump sum. It essentially grafts the alternate payee onto the payment stream. The plan administrator will begin cutting 2 checks every month instead of 1. However, the QDRO must specify what happens if the participant's spouse dies. If the order doesn't include survivor benefit language, the alternate payee's checks could stop the moment the participant passes away. In the academic study of ERISA, this is known as the shared interest pitfall. To avoid this, the order must often be structured to give the alternate payee a separate interest, allowing their benefit to be calculated based on their own life expectancy, independent of the participant's survival. As we conclude Part 5, we have navigated the liquidity window, the administrative hurdles, and the tax withholding traps. We have seen how a 401k can be unlocked for immediate needs without the standard penalties, provided the paperwork is perfect. But even if the QDRO is flawless, there is a looming threat that can render the entire document worthless: the 401k loan that wasn't disclosed, or the hardship withdrawal the participant's spouse took while the divorce was pending. In Part 6, we are going to look at the sabotage and recovery phase. How do you handle a spouse who tries to drain the 401k before the judge can sign the order? We will explore the use of automatic temporary restraining orders and the forensic tools used to claw back funds that have been improperly withdrawn. If you think the money is safe just because the case is in court, you might be in for a rude awakening. We cover the defenses in the next segment. The period between the filing of a divorce summons and the final entry of a qualified domestic relations order is the most dangerous window for any retirement account. In the legal community, we refer to this as the era of dissipation risk. While many assume that the mere presence of a court case acts as a physical shield around a 401k, the reality is that plan administrators are not mind readers. Unless they have been served with a specific legal stay or adjoinder, they will continue to process requests from the account participant as if nothing has changed. This brings us to the crucial academic defense known as the Automatic Temporary Restraining Order, or ATRO. In many states such as California, New York, and Florida, the moment a divorce is filed, ATROs go into effect automatically. These orders prohibit either spouse from transferring, encumbering, or concealing assets without the written consent of the other party or a court order. However, the effectiveness of an ATRO is often limited by the fact that the 401k plan administrator, usually a massive financial institution, is not a party to the divorce. If a participant's spouse decides to take a maximum hardship withdrawal or a loan to drain the account, the bank may process it because they have no record of the ATRO on file. Imagine a scenario in 2026 involving a construction firm owner named Greg in Pennsylvania. Greg is aware that his spouse, Karen, is likely to be awarded 50% of his $700,401,000. Before the first hearing, Greg logs into his portal and applies for a maximum loan of $50,000, and then initiates a hardship withdrawal based on a manufactured medical emergency or a threat of foreclosure. By the time Karen's legal team realizes what has happened, the account balance has dropped by over $100,000. In this instance, the academic solution is not just a standard restraining order, but a joinder or a notice of adverse interest. A joinder is a legal procedure that makes the 401k plan itself a party to the divorce action. Once the plan is joined, the administrator is legally bound by the court's orders. In 2026, sophisticated legal teams use the preliminary injunction, or a status quo order served directly on the plan's registered agent. This essentially freezes the account, preventing any loans, withdrawals, or changes in investment allocations until the QDRO is finalized. Without this step, you are relying entirely on the other spouse's honesty, which historical trends suggest is a high-risk strategy in contested litigation. But what if the sabotage has already occurred? This leads us to the forensic concept of the reconstruction of dissipated assets. If Greg has already spent the $100,000 he withdrew, the court cannot simply conjure that money back into the 401k. Instead, the court uses an add-back. The judge treats the account as if that $100,000 is still there. If the total should have been $700,000, The court calculates Karen's 50% share as $350,000. Since Greg only has $600,000 left in the account after his withdrawal, the court awards Karen the full $350,000, leaving Greg with only $250,000. Greg effectively paid for his unauthorized withdrawal entirely out of his own share. However, a significant complication arises if Greg has already drained the account to the point where there isn't enough left to satisfy Karen's share. In 2026, we see courts increasingly using an offset against other assets. If the 401k is empty, the judge might award Karen a larger share of the equity in the family home, or a greater portion of a separate brokerage account to balance the scales. If there are no other assets, Greg may be held in contempt of court, which can lead to hefty fines or even incarceration, though the primary goal is always the recovery of value. We must also examine the specific rules surrounding hardship withdrawals in the year 2026. Under the current tax code, the definition of a hardship has expanded, making it easier for participants to access funds for various life events. While this provides flexibility, it also provides a weapon for an embittered spouse. If a spouse claims a hardship withdrawal to prevent an eviction, the plan administrator rarely asks for deep proof beyond a self-certification. If that withdrawal happens during the divorce, the non-participant spouse must be prepared to demand an accounting of exactly where those funds went. If they went into a secret bank account or were used to pay for a luxury vacation, it is a clear case of marital waste. Another form of soft sabotage is the change in investment strategy. Imagine if Greg, instead of withdrawing money, decides to move the entire $700,000 balance into highly speculative, zero-date-to-expiry options or volatile cryptocurrency-linked ETFs within the 401k's brokerage window. If the market swings against him and the account loses 40% of its value in a week, Karen's share is devastated. Academically, this is known as an investment breach of fiduciary duty between spouses. While a spouse usually has the right to manage their investments, doing so in a reckless or intentional manner to devalue a marital asset during a divorce can lead to the court holding that spouse liable for the losses. The data from recent case studies suggest that the most effective way to prevent this is the immediate issuance of a freeze letter to the plan administrator the moment the divorce is contemplated. This letter, often followed by a formal domestic relations order, instructs the administrator to reject any loan or withdrawal requests. Step by step, the process for protecting the 401k from sabotage looks like this. First, obtain a full statement of the account at the time of filing to establish the baseline. Second, immediately serve the plan administrator with a notice of the pending litigation. Third, seek an ATRO or a specific injunction from the court if the state does not provide one automatically. Fourth, monitor the account monthly through discovery requests to ensure no unauthorized activity has occurred. There is also the issue of the 401k loan that was taken out legitimately during the marriage. If a loan was taken out in 2024 to pay for a roof repair, it is a marital debt. But if the participant spouse stops making the payroll-deducted loan payments after moving out of the house in 2026, the loan will eventually go into default. A defaulted 401k loan is treated as a taxable distribution. This triggers an immediate income tax bill and potentially a 10% penalty. If this happens during the divorce, who pays the tax? The court will often look at who caused the default. If Greg intentionally stopped the payments to hurt the overall value of the 401k, the tax liability may be assigned solely to him in the final settlement. As we conclude Part 6, the theme is clear. Vigilance is the price of an equitable distribution. The legal system provides the tools to freeze, protect, and claw back assets, but these tools are not self-executing. You must be proactive in securing the 401k before the other side can liquidate it. But even if you protect the balance perfectly, you still face the hurdle of the QDRO drafting itself. Most people think they can just use a template provided by the HR department. This is a massive mistake. In Part 7, we are going to dive into the custom clause warfare. We will show you why the plan's boilerplate forms are often designed to protect the employer, not you, and how to write custom language that covers dividends, stock splits, and the specific 2026 legislative updates that could save you thousands. If you don't control the pen, you don't control the outcome. We go into the drafting room next. Entering the drafting room for a qualified domestic relations order is where the abstract concepts of fairness meet the cold, hard reality of ERISA compliance. Most people mistakenly believe that their HR department is a neutral party that will provide a template to make the process easy. In reality, a plan administrator's primary goal is to minimize administrative burden and liability for the company. Their boilerplate forms are often stripped of the nuanced protections that an alternate payee needs. In 2026, the academic discourse around QDRO drafting has shifted toward high-precision customization to account for a volatile market and complex fund structures. If you simply fill in the blanks on a standard form, you are likely leaving the most valuable parts of the 401k on the table. Let us look at the first critical custom clause: the treatment of dividends and interest. Imagine a scenario involving an accountant named Brian in Illinois. Brian has a 401k heavily invested in dividend-paying mutual funds and real estate investment trusts. The court orders that his spouse, Sophia, receive 50% of the account as of June 1, 2026. However, between June 1 and the actual date the funds are transferred in September, the account generates $10,000 in dividends. If the QDRO is drafted using a standard template that only mentions a percentage of the balance on a specific date, Sophia might only receive 50% of the June 1 balance. The $10,000 in dividends, which accrued on the entire marital pot, might stay entirely with Brian. A custom-drafted QDRO should include a clause stating that the alternate payee's share shall include a pro rata share of all dividends, interest, and other income credited to the account from the valuation date until the date of distribution. Another area of tactical drafting involves stock splits and reorganizations. In the dynamic corporate environment of 2026, it is common for major tech companies to undergo stock splits to manage their share price. Imagine if the 401k contains a large position in a company that executes a 2-for-1 split while the QDRO is in the review phase. If the order specifies a fixed number of shares rather than a percentage or doesn't account for corporate actions, the alternate payee could end up with half the intended value. Academic experts in domestic relations law insist on language that accounts for any stock splits, spin-offs, or mergers that occur after the valuation date. This ensures that the economic intent of the split remains intact regardless of the corporate gymnastics happening in the background. The next battlefield in the drafting room is the administrative fee clause. Plan administrators charge for the privilege of processing a QDRO. In 2026, these fees often range from $500 to $2,000 per order. Many boilerplate forms default to taking this fee out of the participant's remaining share. Or worse, they don't specify at all, leading to a delay in processing. A precise QDRO should explicitly state how these costs are allocated. Does the participant pay? Does the alternate payee pay? Or is it split 50-50? While $1,000 might seem small compared to a $500,000 401k, these fees can become a point of bitter contention that stalls the entire transfer. Consider a case study involving the total forfeiture clause. Some 401k plans include employer contributions that are subject to a vesting schedule. If the employee's spouse has not yet reached 5 years of service, a portion of the 401k balance is not yet truly theirs. It is unvested. If a QDRO is drafted to give the spouse 50% of the total account, but the participant's spouse leaves the company or is laid off before the funds vest, that money vanishes. The plan administrator will claw it back. In 2026, sophisticated orders include a contingent clause. This language specifies that if the unvested portion is lost due to the participant's voluntary termination, the alternate payee must be made whole from other marital assets. Without this, the participant's spouse holds a kill switch over a portion of the alternate payee's retirement. Step by step, a custom QDRO should be built with the following components. First, a precise definition of the valuation date, which is the exact moment the snapshot of the account is taken. Second, a gains and losses provision that ensures the alternate payee's share fluctuates with the market, just like the participant's share. Third, a clear instruction on the source of the funds. If the 401k has multiple investment buckets, like a stable value fund, an S&P 500 index, and a target date fund, the order should specify whether the alternate payee's share is taken proportionally from all funds or from a specific one. Fourth, a survivor benefit provision that protects the alternate payee's interest if the participant dies before the transfer is completed. Let's dive deeper into that fourth point, the precondition of death. Imagine a spouse named Kevin who is awarded $400,000 from his ex-wife's 401k. The judge signs the order on a Monday. On Wednesday, before the order even reaches the plan administrator, the ex-wife is involved in a fatal accident. Under ERISA, if there is no successor alternate payee or surviving spouse language in the QDRO, The 401k might immediately revert to the named beneficiary on file, perhaps a new partner or a distant relative. The $400,000 Kevin was awarded would simply disappear into someone else's pocket. Academic practitioners in 2026 use a deemed surviving spouse clause to ensure that the plan recognizes the ex-spouse's right to the awarded amount, even in the event of the participant's untimely death during the administrative gap. Furthermore, we must address the brokerage window, or self-directed portion of the 401k. Many modern plans allow employees to move their 401k funds into a brokerage account to trade individual stocks or specialized ETFs. This creates a nightmare for plan administrators using boilerplate forms. A standard form might only see the core funds and ignore the brokerage window entirely. If the participant has $300,000 in the core plan and another $300,000 in the brokerage window, a standard QDRO might only split the core, leaving the spouse with only $150,000 instead of $300,000. Your QDRO must explicitly mention that it applies to all assets held under the plan, including any self-directed brokerage accounts or sub-accounts. Historical trends in the U.S. court system show a rise in malpractice claims against attorneys who use the one-size-fits-all templates provided by plans. In 2026, the complexity of 401k assets, including fractional shares, crypto exposure, and private equity tranches, means that the drafting room is where the real value is secured. You are not just writing a letter. You are writing a piece of federal legislation that governs a specific pot of money. We also have to consider the anti-SLAPP and non-interference clauses. These are designed to prevent the participant spouse from filing frivolous appeals or taking other legal actions just to slow down the QDRO process. In 2026, some states allow for interest on delayed distribution clauses. If the participant spouse fails to cooperate with the signature requirements or intentionally obscures information, the court can order that the alternate payee be paid interest on their share at the statutory rate. This creates a financial incentive for both parties to act in good faith and finish the process. As we conclude this deep dive into the drafting room, the message is clear. The words on the page are the only thing the plan administrator cares about. They do not care about the spirit of your divorce settlement or what the judge said in the hallway. They only care about the four corners of the QDRO document. We have secured the language and protected the assets from corporate splits and deaths, but we are now approaching the final hurdle. What happens when the 401k is just one part of a multi-tiered retirement strategy that includes a pension? In Part 8, we are going to look at the double dipper scenario. We will explore how 401ks interact with defined benefit plans, and why splitting the 401k correctly might actually hurt your claim to the pension if you aren't careful. We are moving from the drafting room to the actuarial table. If you think a 401k and a pension are the same thing, you are about to see why that mistake could cost you half your monthly income for life. The distinction between a 401k and a traditional pension, or a defined benefit plan, is the difference between a bucket of water and a flowing stream. In 2026, many seasoned professionals in the United States hold both. They have a 401k that they have actively managed and a pension plan provided by a long-term employer, often in the public sector, aerospace, or healthcare industries. When divorce enters the picture, the academic challenge is that these two assets require completely different mathematical and legal approaches. If you treat a pension like a 401k, you are making a category error that can lead to a massive loss of future purchasing power. Imagine a scenario involving a mechanical engineer named Steven in Michigan. Steven has worked for a major automotive manufacturer for 25 years. He has a 401k worth $400,000 and a pension that is set to pay him $5,000 a month starting at age 65. His spouse, Maria, is focused on the $400,000 in the 401k because it is a tangible, visible number on a statement. However, the true value of that $5,000 monthly check, when calculated over a 20-year retirement, is worth well over $1 million in present-day terms. This is the actuarial table reality that most people miss. In the academic discourse of asset division, we must utilize a present value calculation for the pension. Unlike a 401k, where the value is simply the balance today, a pension's value is an estimate of future cash flows discounted back to the present using an interest rate and mortality tables. In 2026, with interest rates fluctuating, the present value of a pension can swing by hundreds of thousands of dollars based on the discount rate chosen by the forensic accountant. If the court uses a high discount rate, the pension looks smaller, favoring the participant. If they use a low rate, the pension looks like a mountain of gold, favoring the non-participant spouse. Step by step, The process of integrating a pension into a 401k focused divorce settlement begins with the choice between a broad division and an immediate offset. In a broad division, the court issues two separate QDROs, one for the 401k and a second, much more complex one for the pension. The pension QDRO, often called a shared payment or separate interest order, ensures that when Stephen retires, Maria receives her portion of the monthly check directly from the plan. However, the immediate offset is where the 401k becomes a strategic tool. Imagine if Maria decides she wants the house and the liquid cash now. The court might calculate that her marital share of Stephen's pension is worth $600,000 in today's money. Instead of waiting 20 years to collect a monthly check, Maria might negotiate to keep the entire $401,000 and another $200,000 in other assets in exchange for waiving her right to the pension. This is the double dipper trap. If Stephen agrees to this, he is trading liquid, current dollars for a promise of future dollars that he might not live to collect. Conversely, if Maria waives her right to $1 million actuarial asset for a $400,000 401k, she has effectively settled for 40 cents on the dollar. This brings us to the concept of the Majoska's formula applied to high-stakes retirement packages. Historically, courts have used this time rule fraction to determine the marital portion of a pension, but it is often contested when a 401k is also present. If the pension was frozen 10 years ago but the 401k continued to grow, the overlapping years of service create a complex web of credits. In 2026, we see more cases where the court must decide if the 401k contributions were made in lieu of pension benefits. If Stephen's employer reduced his pension accrual rate, but increased the 401k match, the two assets are intrinsically linked. Dividing them as if they are independent can result in an inequitable distribution. Furthermore, we must address the cost of living adjustment, or COLA. Many 401ks do not have an inherent inflation hedge, other than the market performance of the underlying assets. However, many public sector pensions in the USA include a COLA. If Maria receives a fixed portion of Stephen's pension, but the QDRO fails to specify that she also receives a pro rata share of all future COLAs, her purchasing power will be eroded by inflation while Stephen's share remains protected. In a 2026 economy, ignoring the COLA clause in a pension QDRO, while focusing only on the 401k balance, is a fundamental oversight. Consider the case study of a healthcare administrator named Sarah in New York. Sarah has a 403b, which is functionally similar to a 401k, and a state pension. During her divorce, the legal team spent 6 months arguing over the 403b investment gains, but neglected to discuss the early retirement subsidy in her pension plan. Sarah's pension plan allows her to retire at age 55 with full benefits if she has 30 years of service. This subsidy makes the pension significantly more valuable than if she had to wait until 65. If the QDRO for the pension isn't drafted to account for the possibility of an early retirement subsidy, the non-employee spouse might be barred from receiving their share until Sarah reaches the normal retirement age, even if she retires a decade earlier. The data shows that the interplay between these assets creates a liquidity versus longevity conflict. A 401k provides liquidity. You can often access the cash through the QDRO exception we discussed in Part 5. A pension provides longevity protection. You cannot outlive the payments. In a sophisticated 2026 settlement, an alternate payee might choose to take more of the 401k to have an immediate cash safety net, while taking a smaller portion of the pension to ensure they have a baseline income in their 80s. This balanced approach requires an academic understanding of both the Internal Revenue Code and the actuarial sciences. There is also the matter of the Qualified Pre-Retirement Survivor Annuity, or QPSA. This is a federal requirement for most pension plans. If the participant's spouse dies before they retire, the plan must pay a benefit to the surviving spouse. In a divorce, if you are splitting a 401k and a pension, the 401k part is settled once the money moves. But the pension part requires the ex-spouse to be named as the surviving spouse for QPSA purposes. If this is forgotten and Stephen passes away at age 64, Maria could lose her entire interest in the pension, even if she had been awarded half of it in the divorce decree. Step by step, the audit of a dual retirement household looks like this. First, obtain the summary plan description for both the 401k and the pension. Second, hire an actuary to provide a present value of the pension using at least 3 different interest rate scenarios. Third, determine if the pension is a government plan, as government plans like FERS or state-specific STRS plans often have their own unique rules that differ from ERISA. Fourth, evaluate the 401k as the swing asset that can be used to balance out the values if one spouse wants to keep their pension intact. As we conclude this part of the masterclass, you should see that a 401k does not exist in a vacuum. It is often the piece of the puzzle used to bridge the gap created by more rigid assets like pensions. But even if you master the math of the 401k and the pension, there is one final entity that can step in and change the rules of the game: the United States government. In Part 9, we are going to look at the bankruptcy and creditor shield. What happens if one spouse files for bankruptcy during the divorce? Can a creditor take your 401k before you can get your QDRO? We will explore the federal protections that make the 401k one of the most secure assets in the country, and the one loophole that can still let a creditor in. If you are worried about debt affecting your settlement, you need to see how the 401k serves as a fortress. We go behind the walls in the next part. The 401k is often described in academic legal circles as the Fort Knox of personal assets. In the year 2026, as household debt in the United States continues to fluctuate, understanding the anti-alienation provisions of ERISA is more critical than ever. Under Section 206(d)(1) of the Employee Retirement Income Security Act, a participant's interest in a 401k plan may not be assigned or alienated. This federal protection is remarkably robust. It means that even if you are sued for a car accident, a defaulted business loan, or a massive credit card debt, those creditors generally cannot touch your 401k. This creates a unique dynamic during a divorce, particularly when one or both spouses are facing insolvency. Imagine a scenario in 2026 involving a business owner named Anthony in New Jersey. Anthony's logistics company failed, leaving him with $2 million in personal guarantees to various lenders. At the same time, Anthony and his spouse, Isabella, are going through a divorce. Anthony has $800,000 in his 401k. While his business creditors are circling like sharks, they are legally barred from seizing that $800,000 because it is held within an ERISA-qualified plan. However, Isabella is not a standard creditor. She is an alternate payee. The law provides a specific exception for domestic relations orders. This means that while a bank cannot take Anthony's 401k to satisfy a debt, a divorce court can award half of it to Isabella. This leads to a fascinating academic paradox. The 401k is shielded from the world but open to the spouse. But what happens if Anthony files for Chapter 7 bankruptcy during the divorce proceedings? In 2026, the Bankruptcy Abuse Prevention and Consumer Protection Act, or BAPPA, continues to provide nearly unlimited protection for ERISA-qualified 401k plans in bankruptcy. The funds do not become part of the bankruptcy estate. If Anthony files for bankruptcy, his debts might be wiped clean, but his 401k remains intact. For Isabella, this is a moment of high tactical importance. If the 401k is the only asset left because everything else has been liquidated or seized by creditors prior to the bankruptcy filing, her claim to that 401k through a QDRO is her only lifeline. However, we must address the one loophole that can still let a creditor in: the Internal Revenue Service. Federal tax liens are one of the very few things that can pierce the ERISA shield. If Anthony owes $500,000 in back taxes to the IRS, the government can, and often will, levy his 401k. In a divorce context, this creates a race against time. If the IRS files a notice of federal tax lien before the QDRO is finalized and approved by the plan administrator, the government's claim might take precedence over the spouse's claim. Academic case studies from the last decade show that a perfected QDRO, one that has been signed by a judge and accepted by the plan, generally grants the ex-spouse the status of a judgment lien creditor, which can provide a higher priority in some jurisdictions. But if the paperwork is lagging, the IRS can effectively drain the account, leaving both spouses with nothing. Let us look at a case study involving a medical professional named Dr. Julian in Florida. Dr. Julian had a significant 401k and was facing a malpractice suit that exceeded his insurance limits. Simultaneously, he was undergoing a divorce. His legal strategy involved a quick QDRO to move half of the 401k to his ex-spouse, effectively sheltering that half from any potential judgment from the malpractice plaintiff. While this may look like an asset protection scheme, it is a legally recognized outcome of a domestic relations division. Because the transfer is made pursuant to a court order for the support or division of marital property, it is rarely viewed as a fraudulent conveyance. This reinforces the 401k's status as a fortress, even in the middle of extreme litigation. Step by step, the protection of the 401k in a debt-heavy divorce looks like this. First, identify if the retirement plan is truly ERISA qualified. Not all plans are. For example, some solo 401ks, for business owners with no employees or certain church plans, may not have the same level of federal protection as a standard corporate 401k. Second, determine if there are any existing tax liens or child support arrears. Child support is another super creditor that can pierce the 401k shield via a QDRO. Third, expedite the drafting and approval of the QDRO. In 2026, with digital filing, this can be done faster than in previous years, but it still requires proactive management. Fourth, understand the internal debt of the plan. If the participant's spouse took a loan from the 401k to pay off a personal credit card, that loan is a debt to the plan itself. If the plan isn't repaid, the balance is reduced, and the fortress becomes smaller. Another layer of this discourse is the 2026 treatment of inherited 401ks versus earned 401ks. In the landmark Supreme Court case Clark v. Ramaker, the court ruled that inherited IRAs do not enjoy the same bankruptcy protections as funds you contributed yourself. While the rules for inherited 401ks can be slightly different, the academic trend is moving toward less protection for inherited wealth. If part of the 401k being divided in your divorce came from an inheritance that was rolled in, it might be more vulnerable to creditors than the portion earned through employment. Consider the imagine-if scenario where the participant's spouse intentionally tries to use their 401k to hide money from other creditors, but in doing so, they complicate the divorce. If a spouse makes a massive, late-stage contribution to their 401k right before filing for bankruptcy and divorce, the bankruptcy trustee may challenge that contribution as a bad faith effort to shield assets. In 2026, forensic accountants look for these contribution spikes. If the money used for that spike was marital property, the non-employee spouse has a claim to it, but they may have to fight the bankruptcy trustee to get it. Historical trends show that the 401k is often the last asset standing when a family faces financial collapse. Because of this, it becomes the most fought-over piece of the pie. It is the only bucket of money that hasn't been drained by the mortgage company or the credit card issuers. For the spouse receiving the funds, the QDRO is more than just a division of property. It is a transfer of a protected status. Once the funds move from Anthony's 401k into Isabella's rollover IRA or her own employer's 401k, she inherits that ERISA or bankruptcy protection. Furthermore, we must discuss the 2026 impact of Qualified Medical Child Support Orders, or QMCSOs, which are often handled alongside QDROs. While the 401k is a retirement vehicle, the same federal laws allow the court to earmark these protected funds for the health and welfare of children. This adds another chimney to the fortress, ensuring that even if the parents are in financial ruin, the retirement assets can be diverted to meet the fundamental needs of the next generation. As we conclude this 9th segment, you now see the 401k as a double-edged sword of protection. It shields the family's future from outside creditors, but it requires a surgeon's precision to divide internally. We have covered the legal DNA, the tax traps, the drafting warfare, and the bankruptcy shields. We have looked at how to trace the history and how to project the future value. But there is one final step. How do you actually cross the finish line? In Part 10, the final part of our masterclass, we are going to look at the post-QDRO audit and life after division. We will cover the common mistakes made in the final 60 days, how to verify the transfer actually happened, and the psychological shift from our retirement to my future. We are also going to reveal the checklist of the pros that you can use to ensure nothing was missed. The finish line is in sight. Next, we close the case. The final 60 days of a 401k division are often the most precarious, as the psychological exhaustion of the divorce process leads many to overlook the mechanical finality required by federal law. Crossing the finish line is not merely about getting a judge to sign a piece of paper. It is about ensuring that the plan administrator's ledger actually reflects the change in ownership. In the academic study of post-decree litigation, we see a high frequency of cases where a QDRO was approved, but the transfer never actually occurred because the alternate payee failed to provide the necessary rollover instructions or the participant's spouse continued to manage the account in a way that depleted the awarded share. Imagine a final scenario in 2026 involving a retail manager named Kimberly in Arizona. Kimberly has been awarded $250,000 from her ex-husband's 401k. The judge signed the order in March, and the plan administrator sent a letter of qualification in April. Kimberly, feeling the relief of the divorce being over, puts the letter in a drawer and assumes the money is safe. However, she fails to open a rollover IRA or a separate account within the plan to receive the funds. Meanwhile, her ex-husband, still having sole login access to the original account, decides to rebalance the entire portfolio into high-risk emerging market funds just as a global trade shift occurs. By the time Kimberly realizes she needs to initiate the transfer in June, the market has corrected, and her share has lost 15% of its value. Because she had not yet moved the money into her own control, she was a passenger on a ship she no longer had a legal right to steer, but was still financially tethered to. The post-QDRO audit is the step-by-step verification process used by professionals to prevent this exact outcome. First, you must obtain a final statement from the plan administrator showing the zeroing out of the participant's obligation and the creation of the alternate payee's interest. In 2026, most major plans like those managed by Fidelity, Vanguard, or Empower provide a confirmation of segregation. This document is your proof of title. Without it, you are merely a creditor. With it, you are an owner. Second, you must verify the cost basis of the transferred assets. If the 401k contains company stock, as we discussed in the context of net unrealized appreciation, you must ensure the plan administrator has correctly coded the cost basis in the new account. If they reset the basis to the current market value, you could lose thousands in potential tax savings when you eventually sell the stock. Historical trends in the United States show that the administrative gap, the time between the QDRO approval and the actual asset move, is where the most errors occur. In 2026, the complexity of fractional shares and automated dividend reinvestment plans means that the math is rarely a clean, whole number. You must perform a reconciliation. If you were awarded 50% of the account as of January 1st, and the transfer happens on June 1st, your final balance should reflect the initial 50% plus or minus the exact performance of the funds during those 5 months. If the math is off by even a fraction of a percent, it may indicate that the plan administrator used an incorrect valuation date or failed to include dividends. Another critical element of the final phase is the beneficiary cleanup. This is where the academic discourse meets the reality of the Egelhoff versus Egelhoff Supreme Court ruling. Even if Kimberly has received her $250,000 and moved it into her own rollover IRA, she is not done. She must immediately name a new beneficiary for that IRA. Furthermore, her ex-husband must update the beneficiary on his remaining share. In the year 2026, many 401k platforms have moved to automated beneficiary prompts, but the burden remains on the individual. If Kimberly passes away shortly after the divorce and her ex-husband is still listed on the account, federal law may mandate that the money goes back to him, regardless of what her will or the divorce decree says. Let us look at a case study involving the 2026 tax year. A spouse named David receives a QDRO distribution and decides to take a portion as cash to pay off his divorce-related debts. He receives a 1099-R form at the end of the year. However, the plan administrator erroneously marks the distribution as an early withdrawal subject to a penalty. David's tax preparer, not being an expert in QDRO exceptions, calculates a 10% penalty on the tax return. This is why the final audit must include a review of the tax reporting. David must ensure that the 1099-R uses distribution code 2, which signifies an exception to the 10% penalty, or he must file Form 5329 with his tax return to manually claim the exception. Academic precision in tax filing is just as important as the legal precision in the courtroom. The psychological shift from our retirement to my future is perhaps the most profound part of this masterclass. For decades, the couple may have viewed the 401k as a single engine powering their joint golden years. After the division, each party must realize that their engine has been cut in half. In 2026, financial planners utilize Monte Carlo simulations to show how this split affects the probability of a successful retirement. For the participant spouse, it often means they must increase their contribution rate or work 3 to 5 years longer than originally planned to recoup the marital share lost in the divorce. For the alternate payee, it means taking on the responsibility of investment management for perhaps the first time. Step by step, the checklist of the pros for closing a 401k divorce case includes: first, confirming the plan administrator has received the certified copy of the court-signed QDRO. Second, receiving written confirmation from the plan that the order is qualified. Third, opening the destination account, whether it is a rollover IRA or a separate account within the same employer plan. Fourth, verifying that the transfer amount matches the mathematical formula in the QDRO. including investment gains and losses. Fifth, updating all beneficiary designations on all retirement and insurance accounts. Sixth, coordinating with a tax professional to prepare for the 1099, or filing in the following year. The academic discourse on 401k divorce in the USA concludes with a look at the future of retirement legislation. As we navigate 2026, there are ongoing discussions regarding the portability of QDROs and the potential for a centralized federal registry of retirement orders to reduce the administrative burden on families. Until such a system exists, the responsibility for a successful outcome lies with the individuals and their legal teams. You have moved through the legal DNA of ERISA, the forensic tracing of premarital assets, the drafting of custom clauses, and the protection of the fortress from creditors. You now understand that a 401k in divorce is not a static prize to be won, but a complex, tax-sensitive ecosystem that must be handled with technical mastery. The data shows that those who follow this deep dive methodology are significantly more likely to maintain their standard of living and achieve their retirement goals than those who treat the process as a simple paperwork exercise. While we have reached the end of this 10-part masterclass, the application of these principles is just beginning. Every choice made in the drafting room and every box checked in the final audit serves as a brick in the foundation of your new financial life. The case is closed, but your future is now officially under your own management.